Hi everyone, I'm Srishka from Regan Roy, and I'll be touching on all you need to know about domestic treasury management companies. So the South African government first introduced the establishment of the Dtmc regime in 2013 and made several amendments to the South African Income Tax Act, including inserting a definition into Section 1 of the Act, essentially setting out the requirements that need to be met to qualify as a domestic treasury management company. In terms of that definition, a DTMC is defined as a company that is either incorporated or deemed to be incorporated in South Africa, or a foreign company that has its place of effective management in South Africa, and that foreign company, or that company rather, is not subject to exchange control restrictions by virtue of being registered with the Financial Surveillance Department of the South African Reserve Bank. So the introduction of the DTMC regime specifically allowed treasury management companies to choose their own functional currency and in essence allowed for SA companies to incorporate a holding company and hold their African and offshore operations without the SA holding company being subject to exchange control restrictions. The benefits of a DTMC are almost solely focused around the relaxation of South African exchange control rules, particularly as they relate to treasury or cash pooling functions. There are no South African tax benefits to the DTMC regime, as DTMCs are taxed as normal South African domestic companies, other than the fact that the functional currency can be chosen rather than be the rand, and therefore exchange gains and losses in relation to the rand are not taken into account for South African tax purposes. The main benefit of the DTMC regime for exchange control, from an exchange control perspective, is that the South African Reserve Bank allows a 3 billion for listed companies or 2 billion for unlisted companies, which can be transferred to a DTMC, and correspondingly that DTMC can then invest it offshore annually, as opposed to the normal 1 billion rand that is allowed for South African Reserve Bank corporate residents. So when would a DTMC actually be beneficial? So where a group requires a treasury option but uses a foreign treasury company, the foreign treasury company would be caught by the so-called South African controlled foreign company rules. So essentially, the use of a DTMC would then eliminate the additional compliance burden of complying with the CFC rules and regulations, as I've already mentioned. Would also provide a blanket sub approval for the first 2 billion if it's an unlisted company, or 3 billion for a listed company, which would provide relief for the often onerous and time-consuming South African Reserve Bank approval processes. So that's it on the DTMC regime. Thanks for tuning in. Bye.